Get started. Welcome to today's webinar presentation, which is our annual regulatory retirement plan update. And the 2013 retirement plan regulatory update sub-theme for today's presentation will be uncertainty ahead. There's a large number of topics that we're going to get through in the hour that's available to us today. Before I jump into the agenda, I'll start with a couple of housekeeping items. We have muted all of the call-in lines in order to ensure the quality of the audio for those listening today. However, we encourage your questions. So as we go through today's presentation, feel free to use the question and answer and chat dialog boxes to address any questions or uncertain issues that we come across over the course of today's presentation. At the end, we'll try and answer as many of those as we possibly can. Those that we can't answer, we'll certainly get back to those who've provided the questions and give them more formal guidance at that point in time. My name's Eric Daly. I'm the Managing Principal of the Multnomah Group, and I'll be covering today's content presentation. From an agenda perspective, we've really laid out about 8 topics that we're going to spend some time on today. We're going to spend a fair amount of time on DOMA, the Defense of Marriage Act, and the U.S. v. Windsor Decision, and the impact of that decision on Internal Revenue Code, the Employee Retirement Income Security Act, and even a few additional court cases that we have seen post-DOMA, even despite DOMA's recency, in addressing how you as plan sponsors may want to consider administering your plan going forward. We're going to talk a little bit about revenue recapture accounts. These revenue recapture accounts, we received a little bit of just a hint of an inkling of guidance from the Department of Labor that we're going to talk about today and helping you understand to the extent that you are availing yourself in your plan of this type of account, things to keep in mind. I'm going to talk a little bit about the 40485 guidance that we received from the Department of Labor last month. Gives those who are in the process of preparing their 40485 some additional breathing room as it pertains to the distribution of that notice, that fee disclosure notice to plan participants. We're going to talk about something that came late last year but continues to be an issue of uncertainty, specifically for defined contribution plans, although to a lesser extent in the defined benefit pension world as well, and that's to do with Security and Exchange Commission proposed changes to money market regulation. Ultimately, how and what liquidity gates may be impactful to retirement plan sponsors and participants underneath that. Talk about a couple of compliance projects at the Internal Revenue Service, the conclusion of the College and University Compliance Project, and the start of the 457B Top Hat plan for exempt employers, and the Internal Revenue Service's interest in learning more about these non-qualified deferred compensation arrangements. We'll talk a little bit about some of the state alternatives to employer-sponsored retirement plans in a number of states where our clients operate. And then we'll talk last about the looming budgetary issues and the potential impact on retirement plans as we proceed forward. But I'll start with one of the more impactful court actions that has impacted qualified retirement plans in some time, and that certainly was the U.S. v. Windsor decision by the Supreme Court that ruled that Section 3 of the Defense of Marriage Act was unconstitutional. And Section 3 specifically provided that for all federal law purposes, the term spouse referred only to the opposite sex who is a husband or wife. Had a broad array of impacts on a myriad and multitude of federal regulations that were impacted by that more limited definition of spouse after DOMA. But it's also important to point out that the Windsor decision was very, very specific and limited in what addressed related to the Defense of Marriage Act. Certainly, the Windsor Act continues to defer state-to-state determinations as to whether same-sex couples should be afforded the opportunity to marry. So it didn't certainly extend at a federal level, but rather continued to defer to the state-by-state determination. The court's opinion did not discuss whether civil union partnerships, which are not quote-unquote spouses for federal law purposes, would somehow become spousal in their nature. The court decision provided no guidance as to which state's marriage law should control for various federal law determinations. So specifically, although there have been some cases even post the Windsor Act, if you have a same-sex pair of spouses who reside in a state that does not recognize same-sex marriage, does the fact that they were married in a state that does recognize and does permit same-sex marriage cause them to be married or not married in the eyes of the state where they reside or where they may be employed? There was no determination on that provided in the decision. And the court ruling doesn't address whether same-sex marriages have retroactive rights. Some have certainly theorized that if, in fact, Section 3 of DOMA is unconstitutional, as was decided, then certainly it was unconstitutional the day it was enacted, and as a result, the benefits that have been afforded historically to spouses of opposite sex should be extended to spouses of the same sex, going back retroactively, as opposed to just forward from the decision by the Supreme Court. So 1,300, actually more than 1,300 federal laws are impacted by this Windsor ruling, but specific to our discussion today, we're going to focus on the two that impact retirement plans. And obviously the first and perhaps the most confusing of all of them is the Internal Revenue Code, or the IRC. The second, depending on whether your plan is subject to guidance under this set of regulations, the Employee Retirement Income Security Act. Those are the two areas where retirement plans are addressed specifically and affected by the definition of marriage as it pertains to their regulations and guidance. What it does, certainly in states that do permit and have permitted and do recognize same-sex spouses, for instance, the state of Washington, where a number of clients reside, it does normalize spousal treatment in states like Washington. So you have a recognized pair of same-sex spouses, they would be afforded and should be afforded exactly the same treatment as opposite-sex spouses would be post the Windsor ruling. However, it creates a tremendous amount of confusion for what continues to be the majority of states that at this point do not recognize same-sex marriage. I've caveated on the bottom the states where same-sex spouses are recognized. But the questions continue to be, what if I'm married in a state that recognizes same-sex marriage, but I'm residing in a state that does not? I'm living in a state that recognizes same-sex marriage, but working in a state that is not. If I'm living and working in a state that recognizes same-sex marriage, but working for a company whose primary place of residence does not. It provides absolutely no guidance on this issue. Certainly, the Internal Revenue Service is well aware of this issue and is working to provide some additional guidance. But that guidance could take some time to arrive because it is relatively impactful in what the tax treatment would be. There are a number of tax advantages to being a spouse of a participant in a retirement plan, and how to adjudicate those in a way that makes sense and is consistent both with the current states that recognize same-sex marriage as well as those that do not, is going to be challenging, I think, for the Internal Revenue Service to wade through. If not, there have already been some court cases which are driving not precedential because of where they're located and where you may be located, are certainly interesting and may create some context for future court decisions. Maybe the most interesting at this point is Cozen O'Connor versus Tobbitts in the Eastern Court, or the U.S. District Court in the Eastern District of Pennsylvania. We ruled that a same-sex widow was entitled to survivor benefits under ERISA, even though that in the state of Pennsylvania currently does not recognize same-sex spouses. The couple were married in a state that did recognize same-sex marriage, and ultimately it was determined that the same-sex widow in the state was entitled to benefits and treatment. That was a plan that was governed both by, obviously, the Internal Revenue Code, as all retirement plans are, by the Employee Retirement Income Security Act as well. Doesn't that would be true in all courts and in all cases? Absolutely not, but it certainly was the most recent and most interesting of the cases that began to test the bounds of the definition of marriage post the Windsor ruling. Had another one in the U.S. District Court, Southern District Court, Ohio, Obergefell versus Kesh, which ultimately decided that, again, in the state of Ohio, which does not recognize and does not permit currently same-sex spouses, that the two were married based on the marriage that had taken place in Maryland, literally on the tarmac of an airport in Maryland, and the District Court of Ohio recognizing that marriage. So the trend, at least in the early decisions, seems to be the recognition that marriages in states that permit same-sex marriage are being recognized, at least in limited way, in states that may not currently recognize and permit same-sex marriage. I think that for most attorneys that we've spoken with, the real question then is, well, what about a state that actively prohibits, so perhaps has a constitutional amendment against recognizing at a state level same-sex marriage? And we haven't seen any court cases to help provide much guidance on that. There are impacts, so to keep in mind as you decide and look at your plan, ultimately where we're going to see impacts as it relates to how retirement plans are administered. I mean, we've broken out what we think are the 7 areas that certainly are going to have an obvious impact. And most of those have to do with forms of distribution and rights at distribution. So, for instance, qualified plans that have a qualified joint survivor annuity benefit. So ultimately determining who the joint surviving spouse is will be defined by the definition of marriage and will have some impact, DOMA versus post-Windsor, as far as who ultimately can take advantage of those qualified joint survivor annuity benefits. For pension plans and some 403B plans, the QPSA ultimately is determined in a very similar way. So same-sex spouses would be entitled to annuitized benefit protection post-Windsor. So you have payment of account of balance of death. I mean, many plans have as their primary form of beneficiary payout where a beneficiary form has not been completed to a spouse first, and ultimately then that would extended to same-sex spouses in those cases. In any cases, we have hardship distributions under defined contribution 401k, 403b plans that may require or may provide hardship distributions to pay for spousal benefits. So it could be tuition or funeral expenses or other related expenses. That as a safe harbor hardship provision may be extended potentially to same-sex spouses if the more broad definition of marriage is to be applied. Rollovers, certainly loans. You may have a situation where a same-sex spouse would have to consent to a plan loan the way traditionally we've seen an opposite-sex spouse. And I think the first area that we're likely to see it, and we've already seen it for some of our clients at this point, is domestic relations orders. So if you permit and you have a state that recognizes, or any state, frankly, that recognizes same-sex spouses, you will expect at some point to have same-sex divorces. And ultimately, domestic relations orders will need to be qualified, dollars will need to be set aside, and preferable tax treatment may be appropriate in that instance. So there are definitely some areas where, at this point, high impactful elements related to the Defense of Marriage Act and the Windsor Decision that we have talked to or encouraging, as we are with our clients, to maintain the current definition of marriage in the plan document, which usually relates to the definition in the IRC. By doing so, as the Internal Revenue Service provides guidance, your plan will, in effect, automatically be updated until we get guidance that would require a plan sponsor to make an alternative determination. Also important to point out that if your plan is not subject to, for instance, the Employee Retirement Income Security Act, but a governmental plan, which has applicability regulations in the Internal Revenue Code, there may be other state factors that you need to take into account when reviewing the definition of marriage for your plan. Revenue capture accounts. Revenue recapture accounts, for those who may not be aware, are arrangements under which a record-keeping provider traditionally captures revenue sharing from the investment products that are being utilized in the plan and uses those to offset whatever their contractual fee arrangement is. In the arrangements, when the revenue capture exceeds the cost of the service, the excess essentially is captured by the provider and can be used for a number of services. But over the years, we've seen two different methodologies born out of this revenue recapture. One being a plan account and the other being a bookkeeping account. Accounts, and we'll talk about them more significantly, are where those dollars that have been recaptured by the provider are actually deposited into the plan, be it in a trust or a custodial account, depending on the nature of the arrangement you have, or perhaps even the annuity contract, or into a bookkeeping account, where instead of having the actual dollars deposited into the plan, the provider tracks outside the plan the total amount of recapture and allows the plan sponsor the ability to determine how to utilize those excesses. While arrangements have been around for at least the last decade, perhaps longer, in some instances become massively more popular over the course of the last 2 or 3 years. As they create greater transparency, they seem to be in some ways more consistent with guidance that's been provided and some of the necessary disclosures that are required for ERISA plans under 408B2 and 404A5. There had been very, very little guidance on how these accounts were intended to be regulated and maintained. So we did get a Department of Labor advisory opinion 2013-03A that spoke to the specific types of excess revenue recapture account arrangements that are typically available in the marketplace today. An account, as I mentioned, is where the provider captures and actually keeps the excess revenue on their books. As part of the contract they may have with the plan sponsor, they may be obligated to utilize that excess to pay reasonable expenses, necessary expenses incurred by the plan. So a bookkeeping account, by essentially meaning that separate and aside from the retirement plan assets themselves, there may be a ledger of excess revenues collected and expenditures made by the provider as they collect that from the investment vehicles in the plan. The second being the plan account, where that provider actually captures that revenue but then takes it and immediately deposits it, or at least on a timely basis, deposits those excess back into the plan. And then the plan, according to the terms of its document and its fee policy statement, may elect to pay reasonable and necessary expenses from plan assets as they would be allowed to in any circumstance. And in that case, amounts could potentially actually be returned to participants as additional earnings credits. So clearly, between 408B2, 404A5, new fee disclosure regulations on the Schedule C, a recent Frontline piece that talked about investment expenses and the impact of investment expenses on participant account accruals over time, anything that allows a plan to rebate or return some of those fees that have been collected from their accounts to participants could have a positive impact in communicating benefits to the employee population. While 2013 OCA didn't really talk about how those accounts should be policed, determined, maintained, disclosures that need to be made, it was the first time that the Department of Labor referred to those two types of accounts and recognized them as being different in their treatment. It's consistent with what we've been communicating to clients at some point, which is that there are significant differences. While you may take the same $20,000, whether you use a plan account structure as defined by the Department of Labor or a bookkeeping account structure as defined by the Department of Labor will impact both what you have to disclose, how you disclose it, ultimately what you're permitted to do and when you're permitted to use the excesses that have been collected. We prepared a really simple chart that kind of helps illustrate the primary differences in these revenue recapture accounts. The first in which being, is it a funded account? So in the case of a bookkeeping account, no. Ultimately, that excess revenue is still being booked by the service provider as income on their income statement, and perhaps a corresponding obligation to pay out those excesses based on the contract structure they may have with the provider. The plan account, where actual dollars are deposited into actual retirement plans, and as soon as they're deposited into the retirement plan, they really are the sole responsibility of the plan sponsor in determining how they should be utilized. Ultimately, must the assets be exhausted by the end of the plan year? In the case of dollars that are deposited into a plan, one who we talked to with relation to this issue looks at these plan accounts as being in some way similar to forfeiture accounts that you might see in a 401k plan, where you have unallocated assets that have been collected within the plan. It's not a positive thing, and the Internal Revenue Service and Department of Labor don't like to see unallocated dollars inside a defined contribution participant plan. As a result, the guidance that we've provided clients is that really unallocated deposits should be utilized in the year that they're generated. The Department of Labor, very specifically in audit cases that we've helped clients with, has had some question about if you collect excess revenue sharing back in the year 2011, is it reasonable to use those dollars that were collected from participants in 2011 to pay expenses in 2013? The answer would be unlikely. So as a result, if you're collecting excess revenues in a year, it makes sense that you would ultimately want to utilize those in the same year, if possible, that they were collected. And if not, perhaps return the excesses back to participants before the close of the year. You compare that to a bookkeeping account where, again, they're not plan assets. As a result, they're not subject to the same guidance. You could make the argument that it would be best practice still to utilize those assets or utilize those excess revenues in the year that they're generated because they're not actual assets of the plan. They're not subject to the same view from a forfeiture perspective that other accounts might be. The other, can the excesses be credited to plan participant accounts? Again, in a plan account, yes. Like forfeitures, you could take those dollars and choose to reallocate them in a way that's reasonable back to the remaining shareholders. So essentially, take dollars that had been collected from their participant accounts and then returning them back to the participants from which they came. Very, very different than a bookkeeping account. So if you work with a service provider who says, hey, we'll pay $50,000 of your reasonable expenses every year based on the demographics and the economics of your plan, one of the things that they cannot do is write a plan, a check for $50,000 and have it reallocated. There is no practical way to do that, the contribution from the provider as opposed to a contribution from the plan itself. As far as expenses, I think that the expenses are essentially equivalent. You're looking at non-settlor expenses typically. So reasonable and necessary expenses that are associated with administering the plan, and not the types of expenses that ultimately are resultant in plan design changes, establishment of plans, costs that would have been incurred regardless of whether the sponsor had a plan or not. Maybe most importantly, can the account be transferred to another provider? In the case of a plan account, again, dollars that have been deposited could be moved from vendor A to vendor B to vendor C, although they be used annually. But a bookkeeping account, not the case. So if your contract with your service provider says your service provider will write you $50,000, will pay $50,000 of your reasonable and necessary expenses every year, understandably, if you leave the service provider, they stop writing that check, and as a result, if your money you didn't use, it's likely going to stay with the service provider. So recapture account, again, the bullet point levels, a contractual obligation of the provider in a bookkeeping account. It does create an indirect compensation being paid third-party providers. So in a bookkeeping account, in my previous example, where the provider says we will pay $50,000 of your reasonable and necessary expenses, the plan sponsor comes back and says, I'd like you to pay my accountant for the annual audit that is required by my plan. That certainly could happen, but it creates an environment where now the auditor is receiving indirect compensation from the provider. This is very nuanced, but it certainly affects how they would have to potentially report 408B2 filings. It would impact how they show up as Schedule C filing listers for the Form 5500. May have an impact for specifically investment advisory firms as to whether they're perceived as receiving commissions versus receiving payments from the plan, as would be typical under a plan account. Because again, plan account situation, these are assets of the plan. You can use them to credit additional earnings to participants, and it needs to be included on the plan financial statement. So at the end of the year, if you have not exhausted that account and there's dollars in it, certainly that would show up on the plan's balance sheet and income statement. Since we're on the topic of fees, I'll talk about the 2013-02 Field Assistance Bulletin. Provided some relief to those filing and preparing their 404A5 filing for participant fee disclosures. The previous regulation and guidance had essentially said that the notice needed to be provided to participants once in any 12-month period. And the once in any 12-month period created an environment where ultimately, if you provided your disclosure 2 or 3 or a week or 2 weeks prior to the disclosure deadline, you've created yet a new 12-month window. So August 31st of 2012 had been your due date for your notice, and you had sent it out early on August the 15th, then you've created a new 12-month window, and you accordingly are required to provide your 2013 disclosure by August the 15th. And had you sent that 2 weeks early prior to the new field assistance bulletin, your 2014 notice would have had to go out by July 31st, and ultimately creating this moving target of due date related to the annual fee disclosure notice. So 2013-02 Field Assistance Bulletin says if a sponsor has released their 2013 disclosure, they'll have 18 months from that disclosure to publish their 2014. In addition, if they haven't released the 2013 disclosure, the same would be true here, that they would be able to pick an 18-month window from when they last provided their 2012 comparative chart under the fee disclosure notice. So many plan sponsors who have already been fully in the process of generating and providing their annual fee disclosure have either provided it in the last few weeks or will be providing it in the next 2 weeks. and are unlikely to take advantage of 2013-02 Field Assistance Bulletin for this year's fee disclosure notice. However, almost everyone is looking at the next 18-month period as being one to decide annually when they would like to send their 2014 fee disclosure notice. The department has been clear that the reason that they've extended the timing of this filing is ultimately to allow plan sponsors to coordinate additional required mailings that may be out there. Two that seem to make a fair amount of sense, certainly for many plan sponsors to tie their fee notice to, could the summary annual report. So if you're an ERISA governed plan and providing a summary annual report to your plan participants, you have to do that on an annual basis, and using that once a year mailing as a chance to also send your fee disclosure notice certainly would seem to make sense. Others are looking at their qualified default investment alternative notices. There's numerous other notices, but trying to find a way so that every few months plan sponsors aren't required to send out hundreds or thousands, depending on the size of your institution, of additional dense notices to participants. Additionally, the Department of Labor hasn't provided guidance on it, but they are continuing to consider whether allowing a 30 or a 45-day window subsequent to whenever you decide you want your published date to be, to avoid this slipping timeline that I mentioned earlier. So even with the guidance that's been provided under Field Assistance Bulletin 2013-02, you could find yourself in a position by sending your notice 2 or 3 days prior to the publishing date that you continue to move that window forward, and having a 30 to 45-day window at the end would allow folks to maintain a very specific annual timeline for their own disclosure notice, and again tie it to other distribution notices that they may need to make. Regulations. So the Financial Stability Oversight Council issued a recommendation on money market reforms, and this has been a continuing process that kind of came out of the 2008 financial crisis and the liquidity strain that crisis placed on all banking institutions and extended into the money market universe. You recall that during that critical period, it was necessary to extend essentially a guarantee program over money market funds to avoid having a run on those money market investment products. So during a period of extraordinary economic stress, we had governmental intervention to provide a guarantee that would avoid a run on the bank, and specifically related to money market funds. That guarantee was very, very different than any other quote-unquote cash equivalent that you might use in a defined contribution or defined benefit plan. So you didn't see those types of governmental guarantees extended to guaranteed insurance contracts, GICs. You didn't see it extended to stable value. You didn't see it extended to fixed annuities. You didn't see it extended to even variable annuity money market products. It really was exclusively limited to these registered mutual fund money market products that were governed by the Securities and Exchange Commission. And shortly after we had some resolution and the expiration of the guarantee program, we had some relatively stringent changes to how money market products were governed and what was required of them from an investment product perspective. That combined with the current interest rate environment has seen a very, very low period of return for money market funds. Ultimately, in most cases, you're talking about anywhere between 0 and perhaps 0.03% annually for money market returns. In addition to what has already taken place in the market universe, the Financial Stability Oversight Council made some additional recommendations which are being reviewed by the Securities and Exchange Commission and or which are now in comment period. The first is the potential of creating money market products that now would then have a floating net asset value. Money market products currently have a $1 net asset value. They credit additional earnings on a daily basis. But even a period of time where you would see a significant upward shift in interest rates that might push down the value of the underlying fixed income investments that are held in money market funds, not see a situation where the $1 net asset value would change. So ultimately, you may see a period of time where it would take the additional interest payments would have to offset potential capital losses or shortfalls in the underlying bond portfolio, but we wouldn't see that impacted in the value, the shared value of the money market product itself. By floating NAV, you would see money market products in a way that's very similar to bond products. So like in the last quarter, we saw an increase in the yield curve. Bond products in the mutual fund space across the board were down somewhere between 2 and 6%, depending on the duration of the bonds that were in the portfolio. You would have a very short bond portfolio in money market funds. The impact of an increase in interest rates would be less, but participants and investors in money market products in whole would be able to see potentially negative periods of return for money market investments, which is very different from what they've grown accustomed to. They clearly have some challenges related to accounting treatment. Money market funds aren't subject to capital gains, capital losses. If you go a floating NAV, they would be. They would be very similar to other mutual fund products in that way, and that would create some tremendous complexity, potentially, especially for those that have very large positions in the money market universe. Second would be redemption restrictions. So it's clear that all the steps that have been taken by the Securities and Exchange Commission, both up to this point and those that are being proposed, are designed to create an environment where even under another period of intense financial stress, we would not be in a position, or they would not be in a position to have to guarantee these accounts again. And certainly one of the ways to do that would be to engage redemption restrictions, which is the easiest way in some cases to prevent a run on retail and institutional, municipal, and prime money funds. Funds would be, in this environment, required to either impose a 2% redemption gate or to suspend all redemptions for a period of at least 30 days when weak liquidity would fall beneath 15%. So part change that had been made up to this point by the Securities and Exchange Commission was to require money markets to hold more liquid cash available to pay out distributions, and by create a buffer through which, even in a period of intense redemption, that they wouldn't be forced to sell bonds or sell their commercial paper when markets may not be willing or able to absorb their distributions. So create a 30-day gate potentially when run out of cash on the liquidity side would be another way to deal with this. From our perspective on the money market side, it's going to be interesting. There are some items that within the regulation that still have not yet been fully fleshed out, and certainly one is what would be considered a retail fund versus an institutional fund, and what, for instance, in a defined contribution setting would the expectation be that plan would use, retail versus institutional, which would determine whether they were subject to these, if they are passed, these new recommendations. And then whether a liquidity gate would be plan level or would be individual. So we talk about $1 million redemption limitation. Obviously, for a participant, $1 million liquidity redemption restriction is unlikely to affect many participants that have $1 million in money market at any point in time. At plan level, certainly any time you made a change in product or a change in provider, you find yourself in a position having to deal with similar liquidity issues that we have seen for other funds at other times. So whether it's stable value products, guaranteed insurance contracts, or it's not uncommon to see 12-month liquidity for the allocation of an entire position across a retirement plan. So these, again, have not been finalized. They are in comment. They appear to have broad support within the SEC and almost no support within the investment product manufacturing marketplace. Money markets are kind of the float equivalent. Moving to floating NAV, implementing redemption restrictions are all things that would likely reduce the effectiveness of money markets. We're already seeing plan sponsors opting not to use money markets, or at least using competitive ultra-short bond products or insurance contracts because of the interest rate environment. If you create additional restrictions on liquidity and confusion for participants in how they evaluate money market products, I would expect that trend to continue. We do have colleges and universities on the call today, so I wanted to cover briefly, just in one slide, the results of the previously announced College and University Compliance Project. The IRS released the executive summary of findings, which really had four things for you to keep in mind, three of which I would call only quasi, not at all retirement plan related. The first was a huge underreporting of unrelated business taxable income, often related to property or other types of income-producing investments that are owned by the institution, and a failure to pay taxes on those appropriately. 90% of those audited had underreported UBTI. Huge problems in fulfilling executive compensation requirements. So adequate adherence to the reasonable compensation guidelines of 4958. Inadequate board supervision of those types of arrangements was a recurring phenomenon as they went through the audit process. Employment issues, 100% of those audited required adjustments to their wage numbers. That's obviously a very high percentage. And then last, retirement plans. 50% of those had retirement plan deficiencies. The magnitude of those deficiencies was relatively limited. They only collected across the entire audit spectrum product a little less than $250,000 in aggregate. So the problems weren't colossal, but they were repetitive at least. And in addition, the Internal Revenue Service, DPCU, has announced a 457B Top Hat plan. So for all exempt employers, you may certainly have a 457B Top Hat plan. Essentially, it's an executive compensation plan that would allow a participant to defer, in addition to potentially what they do in their 403B, 401A plan, additional 17.5 into a 457B. They announced what they're looking for, and a lot of this comes from the prior slide in the review of executive compensation arrangements. But 5 things that they've laid out. They're trying to verify that deferrals reported on the W-2 actually represent that there is a 457B plan, so that that's been done correctly on the tax filing side. You certainly want to look to see if you are a sponsor who actually can have a plan. I think, unfortunately, this is an area where there have been a number of insurance brokers pushing product without perhaps understanding the specific regulations as to who is eligible to have a 457B, and how these plans differ dramatically from 401k plans and 403B plans, how they need to be run. 7B Top Hat plans are called Top Hat because they should be limited to a select group of highly compensated employees. And I think the Internal Revenue Service has some concern, as do we, from seeing institutions that we've talked to, that the limitation aspect is not particularly well defined and perhaps is not particularly limiting. And that certainly was not the intent of these types of plans. 4 gets into understanding how these plans operate. So do these plans have features that are not permissible for Top Hat plans? You have 401k or a 403b loan feature. You cannot have a 457b top hat loan feature. There is no age 50 catch-up contribution for 457b plans. And you can put the plans away in trust. These are assets that are owned by the employer and are intended for the benefit of the participant, but have to be subject to some risk of forfeiture. Determine whether unforeseeable emergency distributions have been made. Most people are aware of hardship distributions as it pertains to 401k, 403b plans. 457bs in many cases have what's called an unforeseeable emergency distribution. But that limitation for in-service distributions is far more stringent than a typical IRS hardship distribution safe harbor provisions. So saying I want to buy a boat was certainly not unforeseeable. It was not an emergency, and as a result should not have resulted in paying a distribution from a 457b plan. Challenge for many institutions is that those that benefit under these 457b plans tend to be very senior executives within their institutions, and ultimately telling them that they can't get the money that they believe that they're entitled to creates a fair friction that hopefully you've set up a governance process within your institution to manage so that you don't pay these benefits out. Because in our experience, when the Internal Revenue Service finds failures on the 457b top hat side, I have a very simple solution. That's to disqualify the entire arrangement. And do so has very, very significant and onerous tax consequences to the participants who are impacted. So while they may want the $10,000 or $15,000 to buy the boat, the tax impact of having a plan disqualified by the Internal Revenue Service would be catastrophic. A couple that are out on the horizon that we wanted to mention, at least in brief, because I think they could have some impact over the course of the next year to two. And the first is that the number of discussions and state bills related to alternatives to employer-sponsored plans are emerging. There's a lot of talk in my home state of Oregon about Oregon House Bill 3436, which allow Oregon residents to contribute to an account that would be managed by the state, almost like a state-run IRA program that would, for at least many small employers, create an alternative to employer-sponsored defined contribution plans. In the last month, we had U.S. Senator Hatch from Utah introduce a bill that would give states the option to take state-run pension benefits and give them over to private insurance companies to run the asset and distribution piece. That clearly would create a pretty significant alternative to what is the typical standard model for managing state-run plans in the defined contribution and defined benefit marketplace. California last year created the California Secure Choice Retirement Savings Program, which would direct employers that don't have employer-sponsored retirement plans to create essentially an auto-enrollment program into the CSCR SP program at 2% of pay. That would only allow those participants to get out every 2-year window. And in this case, the assets would be managed by an investment committee. So almost a pooled trust arrangement, 3% of their pay would be set aside. Oddly, again, for small employers in California who may not have their own qualified retirement plan. Illinois is also considering an automatic enrollment IRA act. The difference between really California's and Illinois is that in California you'd be looking at a state-run investment pool, where Illinois would be using a model more akin to the 529, where they would hire out and then have a principal protection investment option, a target date set of investment options based on your age, and an equity investment option. But it would give participants some investment choice related to how their dollars are invested. Maryland established the Maryland Private Sector Employees Pension Plan, another equivalent to the programs I just mentioned. And we continue to get a lot of noise from the U.S. Senate Health, Education, Labor, and Pensions Committee about trying to develop programs to target those employers that are too small to sponsor their own qualified retirement plan. And again, I think that these state bills and these state alternatives will likely be the first to try and come up with an alternative to the employer pension programs that we know today, and ultimately which of those models works best would be the most likely to emerge for at some point in the future from the HELP Committee as being an alternative to just having participants or workers who don't have a qualified retirement plan contributing to IRA accounts. That rate of adoption continues to be relatively low, and there is emerging concern at Treasury, labor, almost across the governmental spectrum about the huge retirement gaps, not so much even with those that have defined contribution plans only, although that gets talked about a lot. The real concern is for those that have no qualified retirement plan alternatives and perhaps only have the ability to opt into an individual retirement account. There appear to be great opportunities here. If you go back to the Frontline piece recently on retirement plan fees, the majority, not all, but where the majority of retirement plan fee abuses take place is in the small plan marketplace. I think that small employers, even those who want to establish qualified retirement plans for their employees, find it difficult to do so without having to select a vendor, an investment product universe that carries very expensive investment products. I recently sat through a governmental oversight report by a lobbying industry that tried to argue that the reason for that was that these plans needed to be sold and the people who sold them needed to be compensated. And having an alternative where an employer who wanted to provide an opportunity could opt in or be required to utilize would seem to be a potential resolution to that small plan fee issue. And this is obviously there continue to be massive discussions about reorganizing the Internal Revenue Code, providing some significant changes to how it is currently structured. I think that the defined contribution and even the pension plans that are still in the marketplace today all benefit greatly from the tax deductibility. So employers benefit by making contributions that are tax deductible. Employees obviously benefit by, in most cases, making pre-tax contributions to these plans, and in some limited instances, not paying taxes on accumulations if they're utilizing a Roth feature within the plan. The Joint Committee on Taxation is pushing forward with what they want to call the blank slate approach, which essentially is to say we're going to take all deductions off the table and only selectively add them back in if they make economic sense for the country. Eliminating deductions and create an environment where there will be significant pressure to demonstrate the benefit. And the dollars are significant. So when you look at pension and retirement savings tax breaks, you're looking at $2 trillion over a 10-year period. That's just the tax breaks piece alone. It does appear to be a very strong narrative that would indicate that these defined contribution, defined benefit plans do create a significant amount of social and economic benefit. They take some pressure off other programs, for instance, Social Security potentially. And it is difficult to imagine an environment where there's not some form of tax incentive to continue these types of arrangements for no other reason than there's so much additional concern about the inadequacy of retirement savings for participants. But, for instance, eliminating the tax deductions related to the types of contributions would be reducing tax rates from 1.3 to 2.2% across the board. So not insignificant piece. Also been discussions about capping capping the amount that a participant could deduct. So essentially saying, hey, you can deduct up to $50,000 or $20,000 or whatever magic number you come up with, but that would include your mortgage tax deductions, your children's tax deductions, your retirement tax deductions. And you could get an environment where retirement contributions from a tax perspective get crowded out. That certainly would increase revenues for the federal government. So there are a number of things to continue to watch. Again, there does appear to be a very strong narrative emerging that demonstrates both benefits of qualified retirement benefits from a tax perspective, as well as the fact that the current structure does provide a significant level of benefit kind of across the socioeconomic spectrum, from low-income earners all the way up, obviously, through the wealthy who take advantage in much greater numbers of the larger tax deductions in defined contribution plans. So it creates a great environment for potential changes. Obviously, based on what I've mentioned today, we're expecting additional guidance on DOMA. We're expecting additional potential guidance on 404A5 and some summing of distribution dates for those. We expect over the coming years to get additional guidance on these revenue recapture accounts that I mentioned and how they should be treated and any disclosure notices that need to go with them. And in addition to that, like in each of the last 2 or 3 years, there will be huge changes to potentially the tax code, deductibility limits, and other things that will impact retirement plans. But with that, I'd love to open it up for questions. Again, I'm going to ask you to utilize the GoNR tools to try and provide some questions. I'll give a chance to type theirs out. Wow, seeing none. Either did a terrible job or a good job. Oh, hold on, we've got some. Housekeeping item, question popped up. We do provide a copy of today's slides. We will provide those probably in the next day or two. Check your email inbox. We'll also provide you our annual regulatory update narrative, which goes into these the details related to today's presentation to a greater extent. We'll also include a copy of that. For those who may have had colleagues or others who weren't able to attend today, we have been recording today's presentation, and barring any huge audio problems with it, we'll also provide a recorded version of today's presentation as well for you if you want to go back and can't remember what I said as it related to a particular slide or want to challenge the veracity of my claims, which you're also welcome to do. You'll have an opportunity to do that by listening to the recorded presentation. For your time today, as always, we appreciate your attendance. If there are issues or questions that pop up after thinking about today's presentation, please feel free to email me, eric.daly@multnomagroup.com, or you can reply to the email that will come through in the next day or two with slides. We're happy to try and address as many of the questions that may pop up as you have. Thank you much, and have a great day.